All right, here we go. Welcome to Cash Talks. We're talking all things real estate and just a little bit more. And I have got an insurance agent in California here today that I've worked with. And the guy is amazing. He's very talented, super knowledgeable. He is Zach Schneiderman. He is owner of Schneiderman Insurance. And we're going to sit down. Zach, welcome to our show.
Well, thanks for having me, Cash.
Great to have you on board, man. We want to dig into this debacle that's going on here in California. I know there's a couple other states being affected as well. So many clients of mine, I'm working with them representing selling and buying, and this is having a large effect on our California real estate market with people going forward on these purchases. And I know that you've got to be experiencing lots of that on your end, millions of questions, and you guys are hustling around trying to make things happen, right?
Yeah, I mean, this is a pretty difficult market. It's the hardest market that I've ever been in my years in insurance, and even when I was in real estate development before that. But I've talked to people who come from after the '94 earthquake and saw how difficult it was at that time, and they're saying this is a more difficult market, more challenged now than it was then.
So, what are you seeing on your end of things that you could share with us out there as far as, well, let me ask you this, I guess, why is this happening? The cost of insurance flying through the roof.
So, for a long time, California's regulations have differed from the way a lot of other states regulate their insurance market. It goes back to Prop 103 from the late 80s. Prop 103 made our insurance commissioner a elected official rather than someone who was appointed. So a lot more politics involved in the situation. But it also regulates how insurance companies can increase their rates and makes it go through the Department of Insurance. And if it's over a certain amount, it goes to a third-party intermediary that can intervene on behalf of consumers and advocate against the rate increases. And so with all of the politics involved, it can take an insurance company a long time to get an insurance rate increased because they need that approval before they can do that. And so when you slow down that process and you have a rapidly changing market as we did from, say, 2000 to 2004, so much has moved so quickly, and inflation has hit us that fast. Claims have hit us, wildfires have hit us, so the natural disasters have impacted. The legal climate has changed a lot. So many things all at once. The insurance market needed to make a fast adjustment, and it wasn't able to. And, some things were slowed down by the insurance commissioner not reviewing or able to review insurance rates and approve those rate changes fast enough that they're coming in all at once. And as insurance carriers were unable to get what they needed, they had to make difficult choices. And those difficult choices were they could either change their underwriting guidelines, because that's within their control in most cases, or they could withdraw from the market in California and no longer offer their products. Some are withdrawing overall, so meaning they are no longer offering any insurance and they're non-renewing their existing book of business. Others have put a pause and said, we're just not writing new business, but we'll sustain the existing book we have. Others are selectively choosing what they're getting rid of. And those that have stayed have obviously done so as, with much more difficult underwriting guidelines. And even the process of insurance companies are now reviewing their existing books of business, re-underwriting them, sending out surveys, asking them to get certified for how their homes are maintained and protected. And so what you're seeing is a massive change. And the way we would describe it is this is a long-term change. We wouldn't tell you like where you normally say, oh, it's a change, but the market will shift and rates will come down. That's not expected. This is we should get used to this. We have to start to expect that insurance is going to be more expensive. We're not going to see the rates really retreat in most instances. We still expect more rate to go through the system and higher rates to still be processing. Even today, another major insurance carrier announced that they're going to be non-renewing a batch of policies. So that wasn't their way up until today. That company has decided to announce that they're going to have to non-renew. It says 30,000 homeowners are going to be non-renewed with 30,000. 30,000 homeowners, rental dwellings, and other properties that are residential homes. So yeah, that's
just in California.
Right? That's just in California, right? Some of these carriers that have pulled out don't want to come back in until they get their rates severely increased, and until they can get enough, and it may be several cycles of asking for rate increases before they get enough rate to prompt them to feel like it's worth coming into the risks that California poses.
Gotcha. And I say big rate increases only because I have a few clients that we got them into some new homes, and they were really shocked when they found out what their new fire insurance was going to cost. And a lot of them had to go to the California Fair plan to get that covered because of the problem. And then another thing I got to share with my buyers is it can be a timely deal getting that California Fair plan quote, right? And get it completely dialed in. They've got to get out there and take pictures of your property. They got to look at it. They got to send it all in. And there's been such an overwhelming amount of people doing that it's held up the process. Yes?
Yeah. So there are several places you go when the standard market isn't available. So the carriers that everybody knows on the, they can just name them off pretty easily that are the standard carriers in California. When they're not available, there's alternative markets. The California Fair Plan is the carrier of last resort in California. So
Right.
they're being overwhelmed because all these other carriers have pulled out, that they're having to absorb that. Well,
Right.
they don't have the staff, the resources. They happen to have gone through also a technology upgrade at the time. So that created other problems. But at one point, it was taking us over 30 days to get a quote approved to buy. And we would tell people, listen, you're in a 30-day escrow. You need to call us the day you open escrow, not, hey, we're ready for the loan. I mean, the process of understanding how important insurance is for a real estate transaction, I think, sometimes it used to be the afterthought. Like, oh, by the way, I need insurance and I'm closing tomorrow, right? Okay, no problem. I can solve that. Now, you need to think of it when you open escrow, just like you better be applying for your loan and have those things lined up. The price is now becoming an issue. So people have debt to income ratio issues who are buying on a tight budget. Insurance might throw you out of that. And what we're seeing is the need to use higher deductibles than what people have in the past. And the question is, are you comfortable buying a home, $1 million home, and having a $20,000 deductible if you have a pipe burst? Can you sustain that? Not everybody can afford that. And how are they going to handle that? There are other carriers out there that are what you call non-admitted carriers. That's where like the Lloyds of London and surplus lines market exist. Those carriers they have a little more agility because they don't have the same regulations that the admitted carriers are under, but they also have steeper requirements. So, if the home's over 25 years old, they might say, hey, how old's the roof? How old's the plumbing? How old's the electrical? And if you don't have, and the heating system, and if you don't have those things comprehensively updated, meaning you put all new circuit breakers, rewired, all new plumbing within the last 25 years, they might not cover water damage. They might only write the policy for the depreciated value of the building, not for replacement value. So they have those levers to pull, but those things might not be acceptable to a lender. So now we run into new problems. So all of these things are just a changing climate that we have to help buyers and even existing homeowners understand, because we're seeing massive changes. I mean, if your homeowner's policy was $2,500 and your renewal is $5,000, some people cannot afford the $200 a month difference. Well, I've seen policies that go from $10,000 to $50,000 on a homeowner's policy renewal. Jeez. And how is someone going to handle that? Yeah. And a question I would ask you from an insurance agent perspective is, how's this going to impact the value of homes? Is insurance going to now be something that factors into, is this home worth what I paid for it, or will it be if insurance keeps rising? If I buy in Bel Air or Bell Canyon or Topanga Canyon or Laurel, any of those areas, Pacific Palisades, where's insurance going to be 2 years from now when the dust really does settle over time? And is this going to be something where it's hard for me to sell the property at a value I paid for it, or for it to appreciate, if insurance costs are that much higher? And I'm curious what your take is on that.
It's going to be interesting to see how a lot of these things are going to play out. I mean, we have so many things in the real estate world and industry affecting a lot of this, with insurance in California especially. And it's not just California, Zach, right? It's Florida, Texas, and Louisiana are being affected pretty seriously as well, yes?
Yeah, and then probably Georgia as well.
And Georgia as well. Okay, so
yeah, and there's many other states that are being challenged. I think that the biggest challenges are in some of those states. So California and Florida have unique environments, and that makes it harder for the rates to be adjusted, and then for the public to accept that rate change and to get used to the new norm. Whereas, like in other states, insurance companies can just file a new rate plan and start charging, and they don't need approval from the Department of Insurance. They just need to follow the guidelines of how they rated their policies. They call those a rate and file state.
Okay, gotcha. Well, there's lots of things we could talk about as far as what could affect the market one way or the other, as far as what's going on in the National Association of Realtors right now and the big lawsuit and that crazy debacle. What's going on with our inventory challenges and our interest rate environment too, what's costing people to buy homes. And then now you couple that with insurance costs that are flying up. It is challenging to be a homeowner these days, but it's still worth it in my opinion. And I think things will find, grounds where they can settle down on nicely here eventually. What's helping values now especially in our California market, is lack of inventory. We still have demand, even with their interest rates where they're at, although they have improved since last year. We're down to around that low 6 range to mid 6 range now. And the Fed just talked today, and they're going to leave rates alone, is what I'm understanding, because that inflationary rate is at about 2.5 at this point. And of course, we all know the Fed wants to get that down to 2. He's just hell bent on getting that rate down to 2% no matter what, right? So it's like I don't even know if that's going to ever happen, but the rates are going to have to improve a little bit at some point. The cost of buying, because it's affecting automobile industry, everybody, right?
Absolutely. But from a different perspective, let's think about home builders, right? In order to build a home, they need to buy materials and labor, and that's costing more. So that's going to drive up the cost of new homes. Then add, obviously your interest rate issues, but what about the cost to insure those homes? And part of what happened is in California, the areas where developers have been building are in more remote areas. How we build, we started going out into the suburbs, and you start looking at where some of these developments are located, right? One of the areas that got hit pretty hard, Santa Clarita, the rates in Santa Clarita got hammered. Right? Yeah. Woodland Hills, right? But people started buying and developers started building out in areas in hillsides. Porter Ranch is one of those areas where they're still right up against nature. And so as they're building newer and newer developments, those newer developments that are planned are difficult to insure for a lot of carriers and on the list of places they don't want to insure, or are charging a much higher rate for those. People bought those homes a year or two ago, and now the insurance they bought has doubled, has tripled. And that's really making a difference on how those people are evaluating what they can do. And, I recently looked at my homeowners and my property taxes, right? So I realized that by the time you look at just what I'm paying on my mortgage, I pay more for property taxes and insurance than I do on my mortgage.
How about that? Is that something else? That's amazing.
And it's interesting because you think your mortgage is probably the biggest expense you have, for most people, and it's not. Right. Now, when you factor in and you're paying on an impound account and all that stuff's added up, yeah, those numbers are high. The other thing is there are a lot of people who haven't realized how much interest rates have changed, or insurance rates have changed, because they're on impound accounts, and it might take a little while for their lender to start to catch up and say, hey, we have a shortage. We need more money from you, and we need to start increasing the amount we collect on your impound account. They might be 6 months to a year behind on catching some of that stuff.
All right, Zach, you're spot on about that. But let's keep it honest here and keep it real. How long ago did you buy that house and take that mortgage? Are we talking 30, 35 years ago? What are we looking at here?
Man, I'll tell you, I bought that home about 5 years ago.
Okay, fair enough.
and I've been really happy with and pleased with the fact that I bought that home at that time, how my home has performed. And not only that, I was able to refinance several times along the way and got a really low rate mortgage right now. I mean, that's the thing is even if I wanted to move financially, why would I move? Because I'd be going into an interest rate in today's market. I don't think I'd be able to trade up and get better than what I have.
Yes. Well, that thought right there, that mindset, which I totally agree with and understand, is what's kind of really bogged down our seller inventory, especially in places like California, because they're locked into those rates. But now that the rates it seems to be about 6%, seems to be that magic number in the interest rate world where things start to happen. People start to accept the 6%, and that we're seeing that more because our inventory is starting to pick up. Part of that is because days on market is a little bit longer. I think it was 25 last year in California. Now we're looking around 35. That's just kind of a blanket number for you for days on market, which is still low, right?
Yeah.
But this is what's going on in our market right now. So I was looking at what a lot of people should know too, and you and I chatted about this before about looking for homes in certain areas, especially out in these outer perimeter areas close to nature and these type of things. Home hardening or fire hardening. That's something you really want to look at. And, talking about, the wildfire mitigation proposals and ideas that they have out there to the insurance companies. And there's a whole protocol with that now, right?
Absolutely. And that's one of the tools. So if you're in an area like, high risk area that's being pushed to the California Fair Plan, one of the things that's trying to pull insurance carriers back into writing in those areas is having people follow a process and get certified for their home hardening. The main company, there's one called, the website is wildfireprepared.org. Okay. This is a IBHS. They have a certification process. There's 2 different levels they offer. And while that's being brought in to try and lure insurance carriers to write in areas they're not currently writing in, we're also seeing insurance carriers starting to re-underwrite existing home in areas that are higher risk and saying, hey, do this. And if not, we're going to non-renew you and we can put you on a wraparound with the Fair Plan. So insurance carriers are giving a little pushback saying, hey, if you want us to write in these areas with this certification process, we might just decide that we're going to use this certification process as a way to sift who we really want to keep as well. And I did have a client try and go through that certification process. It was not easy. It's not like it's a cheap, hey, great, I'm just going to pay someone to come out and look at how I did a couple things, because you got to remove a lot of landscaping. If you have trees or plants or shrubs around your home, they're really looking for you to remove almost all of that that's within a certain proximity. So people who have shrubs under their windows or next to their entry, they'd have to remove that and replace it with, concrete or something that's not flammable. If you have wood fences and, pergolas and things, those things might not be eligible anymore, and you may have to remove those and replace them with something else. So I tell people there's an expense associated with this. The ability to have a consultant come out and give you some advice of what you need to do. They paid for that consultant to come out, did all the things the consultant said, submitted their request to get certified, and sure enough, they did not get certified. And after spending all that money and following the protocols they were told to follow, using the people they were told to use on that website, they ended up not meeting it. And they went through several iterations and back and forth of trying to get, okay, well, what do you want us to do? Okay, we'll do that too. Great. It just became something that they realized was not stacked in their favor. And they decided at that point, we'll just go with the Fair Plan. We're running out of time. We need a solution. This is what we're going to do.
Right. Which a lot of people are doing at some point, right? Going to California.
And it's just not ideal. And these are people who he was willing to do anything and everything someone asked of him. And now he went through that entire process, didn't get approved. And now he lost all the trees and beauty that he had built around his house or was part of living there. And he wouldn't have done it if he was just going to go down this road.
Right. We're all going to look like we're living in Palm Springs or Vegas or Arizona or something, going for that kind of a look, right?
Yeah. But so as much as we talk about wildfire in California, I think that's something that gets missed in whether it's the news stories and the way these things are presented. Obviously, we are worried about wildfire. That's a tremendous exposure in the insurance market. And when we're dealing with that, that's being priced there for how we're having many more massive wildfires. But what isn't being talked about is how many water damage claims keep coming in the insurance industry in California. California has, I will tell you, more frequently I get water damage claims than I do wildfire. Okay. The problem is, pipes burst. I mean, think about most homes. You bought a home that's 40, 50 years old. It's got copper pipes. When's the last time someone went and replaced those pipes and gutted that home and replaced all those pipes? Those pipes get old. And
because I know a lot of people go, is it got copper piping? I love the copper piping. I got to have the copper piping. Well, yeah, it's 50 years old though.
Yep. And regardless of which kind of plumbing you have, those things get old, and we have hard water for all the treatment that's put into our water systems. These pipes eventually burst. So insurance companies are now evaluating, and if we look at how much they're charging for each risk, you can see they're charging a lot of money for water damage claims.
Okay.
Well, there are new devices that we can use, and some carriers are requiring on older homes that are whole home leak detection and shutoff devices that automatically shut off the water in the event of a detected possible leak. One of the ones that we've been using, I have this on my own home. It's called Flow by Moen, FLO by Moen. They make your faucets cold.
Flow by Moen. This has been around for a while, right?
Yeah, and Kohler makes one as well, and there's a few others out there. But these actively monitor the water in your home, and if it detects a leak, it will send you a notice, and if you don't respond, it will shut the water off remotely. You could be out of the country somewhere else and a pipe bursts, and the last thing you need is the neighbor calling you saying, "Hey, there's water coming out of your front door or your garage."
Yeah.
Here, it's not going to prevent the damage in the first place, right? You still are going to have a claim most likely, but instead of having a $200,000 claim, you might have a $50,000 problem because it automatically stopped it. And these are really great tools. I like I said, I put it on my home. It's not that expensive to add. The discounts that the insurance companies are giving you in most
That's my next
instances
question.
are absolutely look for my home. I pretty much saved the amount of money it cost to install within a year and a half. I know other people, high value homes, they're saving more money than it's costing them to install in the first year.
I'm sorry, Zach. Costing to install what? I'm sorry.
So when you buy this device, it gets installed by a licensed plumber. Okay. You want to have a licensed individual do it. I wouldn't just have a handyman do it.
Sure.
And it gets installed on the plumbing right around where the meter is to the home, right after the meter. So the water goes through it. And it also connects to your Wi-Fi. And so if it detects running water when it's not used to seeing it, it learns when you flush the toilet, when you take a shower, when your dishwasher's running, when you fill your pool. If it detects something that's irregular, it's going to pop up and give an alert.
Okay.
And from those alerts, I'll get a notice on my phone, and I can just click a button and say, nope, my wife is filling the pool right now. Hey, I just started the dishes, right? But if it's not something you recognize, you can shut the water off. If you don't respond to it within a short period of time, it will turn the water off automatically. And it's pretty easy from your own phone. You click a button on an app, and it'll start the water right back up.
It's amazing. That's fantastic, Zach. But let's keep it honest again here. You said that maybe you're starting to wash the dishes
on occasion, but I'd like to say my kids are doing that for us. We do have to give them some chores.
All right. Well, thank you for sharing that. But I wanted to ask you, what is the cost roughly to install these devices? Is there an average?
Yeah, typically it's probably somewhere between $800 and $1,000 by the time you buy the device and install it on the home. So you can go on Amazon, buy the device directly, so that way you don't have a contractor charging you the increased cost for the acquisition. They charge you more for materials. If you go buy that device yourself, pay a plumber to install it, you might need an electrician to connect power close to it. It's pretty easy, and you should be able to do it within $1,000.
Perfect. All right, $800 to $1,000. And then is there kind of a rough estimate of what that might save an insurer on?
I usually tell people up to 6% on your homeowner's insurance. So it really depends on a few factors.
That's
each individual home and location might matter, or how many bathrooms, how many kitchens do you have in the property? Those things might factor into it, but overall, I've seen it about 5 to 6%.
Right. Like
not every carrier is offering it yet, but you're going to see this as a trend. And older homes are going to require this before an insurance company writes it. So if we have homes that are older than 30 years, a lot of carriers are saying we don't want to insure it unless you have this or proof of it being repiped in the last 30 years. But on high value homes, where you have homes where the replacement cost is over $1 million, we're starting to see that it's becoming a mandatory element in many carriers.
Mandatory. So a home over 30 years and the plumbing has not been replaced, and we don't have any evidence of that being replaced, then that could definitely be a real problem for somebody getting that home insured, correct?
Yeah. And luckily, we went through a few iterations of how this was being processed. So at one point, you had to have this installed before you bought the home and before we could issue a policy. So imagine you've already opened escrow. That process has been changed, because imagine trying to get a seller to agree to install this device in the
Right.
escrow process. Now they're giving us longer after the close of escrow.
Okay.
But the homeowner has to be willing to do that and understand that they've got a short window of time after the close of escrow that they need to get this installed.
That is something else. So you heard it right here. Get your Flow by Moen or Kohler. Get that installed. Make sure you get that set up on your system. Hey, 6% savings, especially with the insurance rates going up and the environment we're in today. That is definitely nothing to sneeze at, in my opinion.
No. I mean,
Yeah.
I tell people, even if it's not your owner occupied residence, imagine for landlord policies, you have all these rentals, and pipe bursts happen with rentals too. Wouldn't it be a nice thing to put on there to have notice, or to have your tenant having access to? The last thing you want it is a pipe burst. It really is devastating. I mean, you have to replace all the floors. What if you have to replace cabinetry? It's I tell people it's an inconvenience and it's a
Yes.
hassle.
Yes.
Whatever we can do to minimize that exposure and the potential for that loss, it's a great idea.
Absolutely, 100%. And you're right. It is a mess. It's invasive. I mean, people or contractors who can come to your home now for weeks or a month or two. And this is why a lot of insurance companies ask, like, move a whole family out into another rental home, where
Absolutely.
or Airbnb or whatever the case might be, But yeah, it's a mess. You're absolutely right.
And remember, when you have claims and all of a sudden you don't like your new homeowner's insurance rate, or you sell your home and are buying a new home, those claims are following you, and you might not be insurable under these tighter guidelines.
Really?
Yeah.
Wow.
I mean, we've had people who, you're buying a home, they filed a claim and got something repaired at their existing home, but the new home they're buying, the seller had a claim. Well, the claim stays with the home that you're buying, but it follows you from your old home too. So those get added up, and a lot of companies don't want to see those claims. And so we're telling people, look, we understand. That's why we're saying consider putting higher deductibles on your homes to keep the rates down, but also, it's not a bad idea if you're trying to avoid filing, a bunch of claims. We're seeing people get non-renewed for their claims history, and that's something we're trying to help people avoid. But we're not going to tell you not to file a claim. We're just going to tell you, look, you got to make a decision. We'll open a claim anytime you need it to be. That's what your insurance is for. But you have to make the decisions of how's this going to impact you once you do open a claim, and
100%.
and how long is this going to follow me for?
Right. Absolutely. Great advice. I mean, really, really great advice. I mean, everything comes with a cost, right? You just can't get away with any of these things. And I have seen a lot of people taking things on and handling some projects on their own these days. And then another thing is the home warranties that come with these too, they don't come with them, but you could, on resale homes, you could actually get a home warranty included, and they do cover a lot of items. You've got to look at each policy, and you can always extend the policies and increase the policies. It's going to cost you more money. But that might be another thing that's coming into play a little bit more. Do you think? I mean, because I believe that in some of these home warranty companies, you could purchase protection against pipes blowing and all these kind of things. Is that right?
So remember, those home warranties do things that are different than homeowners insurance. So they're not, they don't mirror each other. They're not the same thing. They actually can fill each other's gaps. So, if your pipe bursts in your home, your insurance company, homeowners insurance company, might pay for the damage that came from that sudden discharge of water, but they're not going to pay for the cost of a plumber to replace the pipe. That falls under wear and tear. Wear and tear is something that might be covered under the home warranty, just like your appliances going bad. I mean, I kept the home warranty after I bought my home, and it eventually replaced one of my air conditioning units. We had to get the garage door replaced or a refrigerator repaired, and it's come in handy in many other ways. I know a lot of people don't keep it after the first year, but I tell people, look, in the long run, it's insuring all those appliances if you're buying, and other building systems. So it's not a bad idea. You just have to understand the product and where its value is.
Right. Okay. Sounds real good. I understand our insurance commissioner, Ricardo Lara. How's he doing? Is he out there? Seems like I've seen him do a couple discussions with some different panels, and it seems like he's really trying to get things done. How do people see it in the insurance industry?
It's interesting. It's interesting when it comes to the insurance commissioner. There was a period where insurance companies were filing for rate increases, and the insurance commissioner's office wasn't necessarily able to process them as quickly as they could have been, or weren't looking at them and just putting them on hold for a little while. And that gets into the politics of, if you're up for election, are you going to be raising rates on and giving approvals when the people who are going to vote for you are the ones who are paying those increased rates? So there's a lot of question as to, what happened there. But the bottom line is, the market started to dry up. Carriers started pulling out. We started having problems overall, and the competition in the market isn't there. The availability of insurance isn't there right now, and and he is shackled with a lot of those regulations. So he has to work within what the laws allow him to work in. So that doesn't help him that much when you have groups like Consumer Watchdog that is against these rate increases and advocates against them. Even if Mr. Lara decides he's going to approve a rate increase at a certain level, he may meet objection from this other group. When you get into that, the market froze. And I believe that our governor had to put some emergency orders in place and order certain things to be done to try and stabilize the market. And that's what Mr. Lara is working very diligently on right now. And my understanding, at least from my understanding, is, the insurance company I work with primarily is working very closely with Mr. Lara, working on how do we do things, how do we stay involved in the market. But other carriers are doing the same thing. It's just that in the long run, these regulations have to work for both parties. You got to be able to keep insurance companies honest and consumers protected, but you do have to create something where the insurance companies need to be profitable to give them a reason to stay in the state. And what was happening was a lot of these carriers were losing money in California. So when you look and you go, oh my God, I see how much money these insurance companies are profiting. What people are forgetting is they might be profiting on a national level or an international level. But when you start to break it down and say, okay, how are we doing in this state, this territory? So is California making us money or losing money? And every year you look at it and you go, California is losing us money year over year over year. Well, if you're a good business owner, what do you eventually decide to do? And I'll give it under an analogy, because I do like to speak in analogies. Let's just pretend that we own 3 franchises of some fast food business, right? We have 3 different locations, and 2 locations every year they're doing great. They're profitable year in and year out. They make us great money. But we have one location that loses about 75% of that profit back to subsidize that one losing business. Eventually, you're probably going to come to the conclusion of, let's shut that one business down. We'll have 2 instead of 3, right? And so when the insurance companies start saying, you know what, we need to isolate and be profitable in each market. So California needs to run and show that it can stand on its own. And when the insurance companies started to evaluate it from that perspective, they started to realize that being an insurance company in California wasn't making sense. And so either we can find a way to make sure that we're charging a proper and adequate rate for the risks that location and that home present, or your autos present, or the insurance companies are going to make the decision that they just don't want to play in a market that's just guaranteeing them a loss year over year.
Gotcha. Interesting. Well, before I get into asking you a couple hot tips that we could leave our viewers that they could, start to implement and employ in their insurance strategies going forward, one thing I'd like to ask is talking about the governor, Newsom, and with some of these new laws about ADUs and how you could add them anywhere. I imagine you guys are getting to deal with this on your insurance end as well. ADUs now can go pretty much anywhere on any property. The back of the property, like a granny flat, the front of the house, the garage can be converted. A room, I guess, can be converted. It could go on top. And now I understand you can go up to 2 stories high. I am going to interview one of our contractors about that here in a while, but you've got this contractor's background. What do you think about this whole ADU thing, how it's affecting insurance, and also how's it going to affect neighborhoods and infrastructure?
I mean, I think there are a couple things going on. Obviously, the ADUs are one issue, but I think there was another one, and correct me where the right one is. Was there like an SB, was it 9 or something that allows you to divide? So if someone inherits a property, they can divide the lot into 2 and
Right.
So there's another one going on as well.
Right.
But, look, insuring ADUs, is it an attached property? Is it detached? Do we insure it as a separate structure? Is it a separate property? If it's your owner occupied location and then you're renting out, say, the ADU that's detached, are we writing a landlord policy? Are we insuring it as a separate structure, attached? How do you want to be covered? Are you worried about loss of rents? Is it reclassifying the property from what was once a single family home into what an insurance company might classify as a duplex? And the rates
Okay.
are different when you do that. I mean, it is 2 living units.
Right.
One's being rented out. That's not like a house and a guest house. That's now a rental unit, and there's business purposes to this.
Right.
So there's a
Right.
lot of factors that get into that and how we need to insure those. And there are some choices as to which approach you want to take, but there's also right ways and wrong ways. And it's definitely something a lot of homeowners haven't factored into their decision-making process when they're doing it, let alone how are the laws of rent control going to impact these people. While it's not insurance, these are things where our insurance is protecting you for liability. And if you get sued for violating, some housing rights, your liability might get kicked in. And not everybody was born to be a landlord. And they need to make sure they're understanding those laws very carefully before they make the decision to go through this process.
Right. And now you really have to look at these neighborhoods that you might be considering buying in and wondering, what if my neighbors build up 2-story ADUs now? And ADUs, if anyone is wondering, stands for accessory dwelling unit. Okay. That's the fancy term for that. But a lot of that going on now, a lot of ADUs being built. And I think it's going to continue on, especially in areas like, California, where we have high density living and a need for more housing. And so that seems to be the answer there that our government has come up with so far in the state of California. So we'll see how that all plays out. As far as insuring, from an insurance perspective, with ADUs, attached or detached. I've got some very analytical clients and investor types that are going to look at a property and say, should I have it attached or detached? As far as from an insurance perspective, what would be better? I'm thinking attached. Yes.
I don't really think one is better or worse. I think it's a different of an investment.
Okay.
A lot goes into being attached. If you're living in one house, you're renting it out. That all of a sudden factors in how do people like living right next to each other, shared walls, those kind of things. And that's not necessarily an insurance decision. From attached or detached, the question is if you have two, let's say that both units are going to be rented to others, right? If you're renting both out to others, typically you're going to have to write 2 separate insurance policies if they're detached, one for each structure, right? And then we're going to get into questions. Is there a legal street address? Did you pull permits? What did you do? Because there's still a lot of people who did things and they didn't pull permits. Okay. And there's a lot more questions that get involved.
Gotcha.
We just tell people, look, you got to look at the entirety of the situation and figure out what your long-term plan is. I would ask you, how's the home going to sell on the back end? Let's say that you decide you want to sell this property. Is it going to sell better with an attached or detached ADU as well?
That's a great question. I guess it really depends on the particular dynamics of each individual property and how it's all laid out and set up and the whole thing. I would think detached right out of the gate, especially because you can convert those into another rental completely separate from the home, or an office where you could actually walk out of your house and maybe you take 10 or 20 steps, but you're an office environment, right? Or you got the band back there, whatever's happening. Let's get the band back together. We'll get them out.
Absolutely.
In the back, right? So
absolutely.
That's always. So as I'm talking to buyers today now too, and even my sellers that are coming to my listings, or the buyers coming to my listings for my sellers, it's always about talking to someone. Have you talked to a lender? Have you got your lending figured out, dialed in, approved? You've looked at the numbers. You know what it's going to cost you at today's interest rates, right? Maybe they go down a little bit or up a little bit, but look at you have a good understanding of what your monthly expenses are going to be with insurance. Okay. Yes, property taxes. And property taxes, we got a variety of taxes throughout California with the Mello-Roos in there. We want to look at the Mello-Roos and the different special assessments on each property. But this is one thing people really have to make very important, is not just the lender we talk to now, which is ultra important, but now you need to talk to your insurance agent too and look at those numbers too to make sure that you can afford this property. Yeah, are you seeing a lot more of that? People coming to you a little earlier in the process instead of after they've already bought the house?
Look, anytime someone's buying a home, better to talk
Mhm.
to us ahead of time. Even, you're putting an offer in on a home, you want to understand it. We could save a lot of people a lot of time and effort by
Right.
giving you a rough idea, let you know what the market's like, what are the costs of the insurance like, is it going to require the fair plan? These are things you might want to know before you tie the property up. I learned from being on the real estate development side, we did our due diligence, a lot of it before we ever opened escrow on something.
Right. That's key. Due diligence, 100%, especially in our real estate environment today. So I was going to give a couple quick tips from Zach Schneiderman here from what I'm gathering. Number one, let's look at this home hardening and wildfire mitigation ideas. And you said there was a website people could go to kind of look at maybe having someone come out and maybe give them quotes or actually do work for them regarding that.
Yeah, wildfireprepared.org.
Get your flow by Moen or by Kohler, right? And most importantly, before you do anything, call Zach Schneiderman and talk to him about some insurance and get everything figured out up front. Cross those T's, dot those I's, and let's get it figured out, right?
Absolutely.
Zach, great talking to me. I'm so happy you came on. I'm glad we got to chat about this. I learned a lot today, too. I knew a lot about it. I learned a few extra things today, so I'm really glad we took the time to chat.
Me too. Thanks for having me today.
Zach, thank you very much.